Okay, so our next speaker is going to be a virtual talk, and his name is Tommy Huie, and he received his Bachelor's of Science in Electrical Engineering and a Bachelor of Arts in Mathematical Sciences in 2017. He also holds an MBA from the Booth Graduate School of Business at the University of Chicago. He's currently serving as an advisor to financial services organizations, and he has experience in portfolio management and research, wealth management, business strategy, and risk analysis. He has also served 2 terms on the board of the Association of Rice Alumni. He's a trustee emeritus of Rice, and is a member of both the board of advisors for the Jones School's Graduate School of Business and the Engineering Advisory Board for the School of Engineering.
All right. Well, hope you can hear me okay. Thanks for inviting me to the conference. And I want to thank Steve in advance for controlling my slides. So as we go to the first one here, I know it's been a terrific, thought-provoking day, but let me push your brains just a little bit more here and throw out some open questions for quants that I've come across here just in the last week or so. So one is that comes to mind, this is meant to be pretty broad in terms of these questions for everyone in the audience. So hopefully it touches everyone. Now, first one is, how do we model meme stocks? You know, what do you do about a GameStop or an AMC Entertainment? We try to live in a world that is logical and rational, and yet emotions come into play and crowd behavior and so forth. So how do we try to model that? Another question is, how do we incorporate cryptocurrency into asset allocation? I think we had some terrific comments earlier. Manolo talked about the cryptocurrency, and others have as well. And how do we try to put that into an asset allocation framework? Should institutions hold it? Should individuals hold it? You know, those are some questions that I'd like to think that quantitative finance practitioners could help answer. And then something that affects almost everything in our analysis is, how did COVID impact our data sets? Went through for many a life-changing process here in the last couple of years, but it also certainly impacted a lot of the data that we analyze and look at. And how do we account for any aberrations, or is it something that we just count as part of our analysis, and we look at some of these dislocations as we have in past large-scale events? And then ESG, that's been covered by a number of speakers. Michael did a terrific job going through that, and others have mentioned that as well, including Max here in the fixed income session. Aside from the financial impacts it has in terms of profit motive, you know, is it arguably virtue signaling? And do we try to ascertain a value on that in terms of the processes that we go through in looking at finance applications, as well as arguably the emotional impact and long-term projections in terms of what that might entail? So I throw out these questions, not that I have any definitive answers, or that necessarily any of you in the audience have any definitive answers, but really these came up in a conference last week that I attended, part of the Chicago Quantitative Alliance, or CQA, for those of you who might be familiar with that. I was there, helped with the founding of it 29 years ago. And we tried to come up with some provocative talks. And these were some of the questions that were posed, again, that led to a fair amount of debate, no definitive answers, of course. We also talked about a few other topics that might be of interest. And again, I can't cover them all here, but the heartbeat trades involved with ETFs, the impact of quantum computing in terms of our practice going forward, Bitcoin, of course, and then AI-driven security analysis as it pertains to looking at financial statements as we think about the technical analysis aspects, how does it impact portfolio construction and so forth. So my discussion here, again, in the next 20 or 25 minutes, is really meant to be a survey across different disciplines and impacts on quantitative finance. And I like to think this is a bridge to the panel discussion, to which I'm very much looking forward to, about the next decade in quantitative finance. Steve, we can go to the next slide, please. So again, this is meant to be a survey of applications. And you know, the goal here is to really push forward what the breadth of quantitative finance applications are. So for all of you academics out there in the audience and future practitioners of finance if you're a student. I hope this helps kind of push the boundaries here to let you think about what is possible, what's happening today, where and how quant finance is used, and then hopefully provide some areas of thought that you can push forward in terms of your research going forward. So some of the things that we'll discuss is quantifying fuzzy complex data, some of the applications that are going on there, alternative data sets, and where quant finance is done in terms of investment analysis, insurance and credit, and of course, Fintech. One of the items that we discussed in our conference last week that I'd like to suggest here, there's a new book out called In Pursuit of the Perfect Portfolio. It's written by a couple of practitioners, Andrew Lowe and Steve Forrester. And the interesting thought there is that it really traces through 10 well-known practitioners, Nobel laureates and so forth, and some of the hurdles they encountered as they produce their path-breaking research. It's amazing how much serendipity, as well as overcoming near failures, have really challenged those folks, and yet they succeeded in spite of that. So I'd like to think some of that would help motivate all of you in the audience to continue forward with your research, as well as us practitioners who are involved on a day-to-day basis in managing large sums of money. You know, the serendipity part, for example, Harry Markowitz had a chance meeting with a stockbroker as he was preparing to meet with his thesis advisor, which during that conversation, as Harry was in the waiting room before he met with his advisor, the stockbroker challenged him with a couple of different questions that he was facing, and Markowitz came away and wound up doing the research that produced his seminal paper. Bill Sharp was really going down the wrong path. He was working on some research and transfer pricing when he was advised to change to look at stock prices. And one other element that came out in terms of Bill Sharp was that he actually failed the 4th grade when he was a young child because he didn't memorize the multiplication tables far enough. He only did through 10 times 10, and the test was on 12 times 12. And as the story goes, he failed that test and was in danger of failing 4th grade. So just overcoming some of these silly failures and continuing to persevere through your research work, I hope all of you will be motivated to continue doing so and pushing forward. Next slide, please. So as we go, before we go through this survey of various topics, I just want to throw in a few pitfalls that all of us have faced on that note of continuing to try to persevere. You know, clearly models can't fix bad data. And, you know, sometimes we take certain assumptions or simplifications for granted. You know, we're thinking there's too much certainty in the data, and there are always biases, of course. So in the only picture that I have in these slides, everything else is bullet points. I thought this was very interesting. One of the presenters recently, I found this in terms of talking about how much capital and time goes into data cleaning and collection. And when it seems almost, you know, beside the point in terms of having to go through the exercise, it's so important in terms of research. And for all of you who have already gone through this process, obviously I'm not saying anything new for you, but you know, for those who are getting started and thinking about the volumes of data sets that we you know, have to contend with, to try to go through and come up and find those nuggets of information, those sparks of knowledge, you know, data quality is just very difficult. And going through artificial intelligence or machine learning process doesn't always work. It's really getting into the nitty gritty and spending a fair amount of time and having a good research team to work with in terms of being able to fact check each other in terms of the process. So looking out for those pitfalls, I think is one of the keys here in terms of finding success going through our research work. Next slide, please. So trying to think about some of these fuzzy, complex concepts, you know, and some of these are certainly ESG related. And once again, Michael did a terrific job in going through that. think about some of the topics in terms of empowerment, how people's behavior become involved in terms of their actions. Behavioral finance certainly comes into play here in some of the areas, but I think there's probably a lot more work to be done. And a lot of people are actually going through some of the various research efforts in this regard, along with changes in corporate governance in terms of expectations, how not only how companies are run, but some of the various issues that come into play and affect things indirectly that wind up changing the finance function. Carbon footprint, as well as diversity and inclusion, those are I think there's some real opportunities for AI and ML to analyze some of the current events and news rather than looking backwards and thinking about how the how security prices might be impacted, for example. Really trying to take that next step and looking forward by analyzing current events and current news are pretty can be very impactful. Not only financially, but in terms of where future research efforts might be taken. Things that look at central bank regulation, for example, or tax policy in Europe, carbon markets, sustainability-linked bonds, as well as a couple of terms I hadn't come across very often. Green bonds, yes, but blue bonds, thinking about water quality and many of the climate related issues are certainly creeping into finance areas. And more importantly, the data sets behind that in a lot of different areas are creating some rich data sets that I think quantitative finance practitioners will be able to take advantage and to be able to contribute to the literature in terms of many things that we do. Next slide, please. And as far as data sets, there really are so much to be able to go through. Everyone knows about the social media networks, Wall Street bets, Reddit threads, weather-related phenomena, certainly in terms of satellite imagery, being able to consider the really rapidly changing areas that some of these data sets are able to reflect in real time. The lag time certainly is almost non-existent for some of this. Credit card transactions is an area that I think, particularly during the pandemic, has changed a fair amount, and being able to deduce patterns and insights from those kinds of data, I think are potentially very impactful in terms of the quantitative finance practitioner. Sensor networks is a little bit new, of course. I look to some of the advances in autonomous vehicle science and industrial robotics to potentially provide us some insights in terms of where companies are headed in terms of their operations and industrial production. And then that, of course, has potentially an impact on their security prices. And to think about even new data sets emerging, such as pledged securities. So that's starting to show up in the press a little bit, thinking about the data involved in some of these areas that are previously well hidden. They're starting to see a little bit of transparency, a little bit of light of day, and that has some obvious impacts in terms of security pricing, where opportunities may lie. Certainly discussions about iceberg tracking earlier and some of the trading function kind of get really linked in here in terms of pledged securities, as well as other things like dark pools and so forth. Next slide, please. So if we come back to where things started, certainly in terms of where my career started, traditional investment analysis, there's so many different things going on. And a lot of you already know this, but it's always helpful for me as a reminder just to think where some things have already been examined and has been really well covered in the finance literature. But there are always some other areas that perhaps the next steps can be taken because the data has increased so much more. Quantamental is a term I presume many of you are familiar with. There's sort of the formal version where it's an enhancement or augmentation of working with human portfolio managers to incorporate large data sets and assess risks. From a personal perspective, from my own past experience, it's really making fundamental portfolio managers and analysts really think through and force them to consider new data sets and again, the timeliness of how they get incorporated into security price predictions. That's really where Quantamental has made significant inroads. And I think there are still some even greater possibilities. And that's where we as practitioners in this wide field are really able to help. Factor risk premia, enhanced beta capture, and true idiosyncratic alpha in equity strategies are pretty self-evident. Security price risk models, Dexter mentioned BARA in his opening keynote. And that was really when I started my career learning about BARA and all of the advances since then in terms of multi-factor risk models and where the pitfalls are in terms of analyzing risk factors and security price data. The idea of a robotic or robo-analyst in terms of analyzing financial statements. There's a company in Nashville called New Constructs that I became familiar with that's really trying to take that next step here and looking at tens of thousands of SEC filings and just looking at it from that standpoint. Fixed income area is certainly no stranger to the investment analysis. That's been covered extensively. Max did a terrific job on that. But just thinking about where all this sort of comes together in terms of looking at the financial statements, but then also bringing together potentially sentiment analysis and really putting it together into a current price analysis. There's a terrific new book by Antti Ilmanen, who is one of the co-heads of, I believe, portfolio solutions at AQR Capital Management. He wrote a 500-page tome, if I'm not mistaken, about 10 years ago in terms of security analysis. And he's come out with a new book here, I think just in the last few weeks, called Investing Amid Low Expected Returns. There's for those of you who may be less familiar with the literature in terms of quantitative finance, he does a great summary of a lot of different topics in one place. In fact, there's actually a podcast I recently heard about where Antti was interviewed. I think an asset management firm called Resolve Asset Management helps put together these podcasts, and Antti was interviewed and just going through the various topics in terms of, for example, is there illiquidity premium, or arguably is there a discount because of illiquidity in certain asset classes? Is the credit premium ascribed to fixed income securities? Is it really more focused on the fallen angels, the investment grade securities and bonds that fall out of favor? Is all of the credit premium really focused on those fallen angel securities? And the impact of inflationary regimes, a hot topic of today. Antti does a terrific job here in going through that. So that was something that I would recommend to all of you in the audience. And one thing I missed, of course, ESG, tilts, conditionally optimal portfolios. Again, Michael did a terrific job on that earlier, but there's so much more work that can be done. And I think we can make a terrific contribution to the literature, we as quantitative finance practitioners. Next slide, please. Let's keep track of time here. So insurance and credit, that's another sector where there's so many elements in terms of policy underwriting, looking at catastrophic risk, credit decisioning and credit scoring, and trying to remove biases. So we think about diversity and inclusion issues that come up to really create a more efficient market as it relates to insurance in particular, but also on the credit side. And as databases become a little bit cleaner, a little bit more available, and being smart in terms of those data sources, mining data for credit signals is particularly important. There are some applications here that go to municipal and state debt finance. As you think about the green bonds that we discussed earlier, and really where the risks are that a lot of states and municipalities face when they're borrowing money from and going to the debt markets. And then in going down to the other extreme in terms of microfinance for those smaller entrepreneurs who don't have access to traditional areas of finance. I think there's some terrific applications that could also create more efficient markets for those. And to think about the, being able to offer loans to those small businesses and looking into the whole idea of macro forecasts in terms of the impact that has on the insurance and credit sector. Next slide, please. So certainly fintech, there are many different areas that really get away from what I would call traditional quantitative finance, and yet has a huge impact. Think about private market company operations, as well as customer data platforms and inventory management services. So all those elements really come into play here, that you see it in some of these new innovative companies, these startups. And then for the traditional finance players, the micro market structure, looking at the impacts on electronic exchanges and alternative trading systems and dark pools. There is the sort of zig and zag as transparency, as light is shined in certain areas. Players are already moving to create untransparent markets where there's lack of transparency, to be able to try to take advantage of market peculiarities. And researchers are really sort of continually pressed to be able to shine that light, the proverbial light, on those markets. Natural language processing has been around, as you're all aware, for many years, but being able to take advantage of the faster processing power, look at trend analysis, sentiment in terms of specific securities and companies, and really advanced text analysis. And those are some of the areas that there's a lot of horsepower that is being applied. Whether that becomes fruitful or not remains to be seen. But I do want to offer one case study as we go to the next slide. There is a company called StockSnips. I encourage you to all take a look at their website as well. That tries to systematically view current sentiments. So I think, as many of you are aware, measures of investor sentiment currently are very much backward looking. We're able to try to piece it together, and then but trying to make those predictions going forward, it can be pretty difficult, particularly with the fast pace of news releases and things of that sort. So trying to take a NLP approach of looking at news snippets and looking at how the topics are worded, whether there's any implied sentiment, looking at the various spectrum, or how bullish or bearish is some of the sentiment exposed in some of those news items. And thinking about where the sources are, whether it's SEC filings or whether it's a trusted news source, or one that is really just itself an automated process that spits back out news releases, press releases, trying to attribute and then to weight those news items. This firm suggests that the messages that come out, say, for example, around an earnings release or an M&A event, they have tried to apply a Poisson distribution model in which to look at the volume and frequency on news sentiment, and then to further use an artificial intelligence approach to be able to analyze that and derive a score that would suggest whether, going forward, a short-term as well as a medium-term price movement on the underlying company in terms of both its equity and as well as its debt. So those are the kinds of applications that I think many are finding exciting. I think there's this incredible race in which to analyze these kinds of sources and develop these kinds of processes. And as we go to the last slide, it's really, I'd be remiss as a former trustee and being on the board of advisors of the engineering school as well as the business school, not to remind everyone in the audience of some of the opportunities available to the Rice campus. The previous one at StockSnips, unfortunately, there's a close relationship they have with Carnegie Mellon University, but I certainly would push the Rice faculty and students in terms of being able to come up with something just as good or better. Lily and the Rice Alumni Group for Entrepreneurs and Innovators Network is they do a very good job. It's in some ways it's at its nascent stages. I think there's a lot more to be done. I hope all of you will contribute to that and to think about opportunities to devote your energies and talents to the efforts of all the entrepreneurial startups that are going on campus. The D2K Lab, of course. And then within the Office of the Provost, many of you are probably already aware, but 3 key hires searches are undergoing that will hopefully infuse more research and more innovation into the process. I think Rice has a terrific opportunity for continuing to advance the science involved in quantitative finance. And I'd be remiss also if I didn't mention that there are a number of investment challenges going on, and the CQA helps sponsor one such challenge for quantitative portfolio management. And I'm pleased to announce that I'm not sure it's quite public yet, but it soon will be if it isn't already, that investment team at the Jones Graduate School of Business won first place in our Chicago Quantitative Alliance Challenge. It really models the efforts behind creating a long-short quant fund and thinking about not only the return side, but also the risk, and being able to communicate the portfolio process. And the Rice team did a very good job. So, and I would also add at the very end here, before I pass it back off, to say congratulations to the CoFES team for the milestone anniversaries here. It's an honor to be invited to speak. So with that, let me conclude this presentation and open up for any comments. I'd love to hear your ideas.
Thank you, Tommy. Any questions?
Tommy, thank you, as always. This is Kathy. Having worked on pricing models and incorporate news sentiment, I really like the fact that you put a shout out for that. But I wonder where you see sort of a technical approach from a modeling perspective. Do you still see that coming into play, or do you think that we're pretty much in a machine learning world where maybe those models will dominate over some of the more mechanistic models that help us understand markets a little bit better?
Yeah, hi Kathy. Thanks for the question. Which is very interesting. The opportunity that we have now with the latest technology in which to do calculations so much faster and to be able to evaluate data so much more quickly. In some ways, that's a godsend, right? Because we're able to really do more extensive research, whereas perhaps that wasn't possible before. But I think it also gives us the opportunity to go down the wrong paths too many times, because we have that computing capability. And so to your question, I think it's a little bit of almost like Monte Carlo simulations, where there's one right scenario, one answer somewhere in there, but you're doing hundreds, thousands of simulations, and not all of those will necessarily pan out. So I'm not sure, depending upon how the researchers, what they're able to, what hypotheses they come up with the test, and then where to go with that. I suspect there are some things here that we will discover that are not currently expected today that will be incredibly fruitful and productive. And I suspect some of our discussion in the panel here upcoming might highlight some areas that will perhaps be a surprise to many of us.
Okay, thank you. Are you going to be able to stay on for the panel?
I'm looking forward to hearing it, yes.
Okay.
Any more questions? No? Shall we, do we still have time, or? Yes, okay. I think it's Alumni one, yes.
So somehow we have to transition to the panel.
Okay, thank you, Tom.
Thank you.